Hello everybody, welcome to the video on mergers and acquisitions interview questions as part 3 of our investment banking series. In part 1 and part 2 of this series, we saw interview questions on valuation methodologies and financial modeling respectively. And as you already know, both of these domains provide opportunities to a large number of professionals in the finance sector. The links to both of these videos are available in the description box below. We also saw important interview questions on financial analysis and basic accounting in these two separate videos. These videos have already helped thousands of candidates and I'm sure they'll be helpful to you also. The links to both of these videos are also available in the description box below. You can watch them after you're done with the current one. In today's video on mergers and acquisitions, let's see some very important conceptual and situational questions that are usually asked to the candidates during the interview. If you're really serious about cracking your next interview, watch every single second of this video without skipping any parts of it. Ready? Fantastic. Let's start. Question number 1. What's the difference between mergers and acquisitions? Now, this is one of the most basic and important questions because these two terms are usually misunderstood and used interchangeably. A merger actually occurs when two separate entities combine to create a new joint entity. No cash is usually required to complete a merger. The individual power of each constituent company gets diluted and a new management structure gets created here. You would notice that the mergers are usually voluntary in nature. The companies involved here are roughly the same size and scope. The purpose here is to reduce the operational cost, expand into new markets, boost the revenue, profits and market share. But if you see in case of acquisition, the bigger company here acquires the smaller one. The smaller company here ceases to exist. Its assets become a part of the larger company. A lot of cash is involved here and the buyer holds all the power. Acquisitions are driven by a desire to acquire the technology, suppliers, outlets and other such resources of the target company. This saves the buyer years of research and development, capital investment and efforts while increasing its share value. The acquisitions could be friendly or hostile. Moving on to our question number 2 now. What do you know about horizontal and vertical merger? Now see, horizontal mergers take place when two companies operating in the same industry combine. Usually, they are direct competitors offering same product or service. The purpose is to increase the market share and economies of scale while reducing the competition. Such mergers usually happen in industries with fewer number of firms. For example, the merger of Vodafone India and Idea Cellular was a horizontal merger. Now, two companies that produce parts or services for same product merge. The union is referred to as a vertical merger. Such mergers are done to increase the efficiencies and synergies. They also help in reducing the supply chain cost, improving the operational efficiency. These vertical mergers are common in industries where integrating the supply chain can provide significant cost advantages and operational efficiencies. For example, when Tata acquires stakes in its supplier companies, it is an example of vertical merger. So, by now you must have realized my approach here. What I'm trying to do here is I'm trying to provide a little detailed answers to whatever question is put to me. Why am I doing this? I'm doing this because most of the candidates would provide to the point answers to whatever is asked to them. If I provide a little detailed answers, that will help me stand out of the crowd and gain the trust of the interviewers. Okay? So with this, let's move on to our question number 3. Name the different types of mergers and acquisition firms that operate in the market. Now see, the process of merger and acquisition can get quite intimidating for the companies and management. To facilitate the whole process, different types of firms operate in the market. For example, investment banks, law firms, audit and accounting firms, consulting and advisory firms, etc. Be prepared to discuss about them in detail during the interview. Our question number 4 is again basic but very important. So pay attention. What do you know about acquisition adjustment? Now, acquisition adjustment refers to the difference between the purchase price that is paid by the acquirer and the book value of the target company. This difference in the amount is because of the premium the acquirer pays to the target company for its goodwill and other intangible assets that add value to it. This may also include any patents, customer relations, R&D work, etc. Now, if you're appearing for an interview at an investment bank, our question number 5 here is again very important for you. What role do investment banks play in the merger and acquisition process? Now see, the role of investment banks in mergers and acquisitions process includes a lot of things. The first one being target identification, where they develop a list of all the prospective targets. And for all these prospective targets, they collect a market intelligence, which includes any information about the targets that may impact the deal and other market conditions also that may impact the deal. Then they go for client consultation, where they pass on all this information that they have collected to the client and to find out their interest is the basic purpose they do this. Okay. Then they carry out a current valuation analysis and find the price expectations of the target if the client is interested. Carrying out all the negotiations and documentation work is also their responsibility. And finally, when everything is done, closing the deal, where they conduct the management meetings, prepare the closing documents, and finally close the deal is what they do. There is also a possibility of investment bank representing the selling side. We just talked about the buying side only, but now we are talking about the selling side. So if they are representing the selling side, in this case, they may conduct an auction to determine the buyer also. Some of the famous investment banks that operate in the world are Goldman Sachs, then Morgan Stanley, JP Morgan Chase, Barclays, Deutsche Bank, Credit Suisse, etc. Moving on to our question number 6 now. What are some of the most common reasons for acquisitions to fail? Now see, many acquisitions that look very promising on paper fail miserably during implementation. The practical difficulties that you face during implementation are referred to as acquisition indigestion. Some of the most common reasons for this acquisition failures are: number 1, insufficient due diligence. That is, you are being over positive about the acquisition, and because of that, you don't conduct your due diligence. You realize a lot of things during the implementation, which make the acquisition fail. Then the second thing that usually happens is overpayment, where you miscalculate the value and land up buying a company that is not as attractive in reality as it looked on the papers. Then many times there are cultural clashes also, and this especially happens in case of international mergers and acquisitions. The management style, corporate culture, work environment in the two companies may be very different, which make these acquisitions fail. Then there could be poor execution that may lead to a loss of key customers, employees, shareholders, and even some of the most competitive products also. Many times regulatory hurdles are a big problem, where compliance issues may delay or absolutely block the process. This again usually happens in international deals. And lastly, changing market conditions may actually impact the viability of the deal altogether, which may make the acquisition fail. Careful planning, performing your due diligence and analysis, hiring some independent consultants can help you mitigate these risks. So this is a very, very important question that tells about your understanding and maturity. So make sure that you are prepared to answer these questions, and the best way to prepare yourself is anticipate these questions. If you go unprepared, you are bound to fail, because these type of answers don't occur to anybody on the spot. They need preparation. Okay, let's move on to our question number 7 now. And our question number 7 is: what are some common strategies used by the firms to resist the acquisition? Now see, if the management of a target company is opposed to a takeover, they may use various tactics to make themselves less attractive to the acquiring company. These strategies are referred to as poison pill defenses. Here are two common strategies used by the targets. The first one is crown jewel defense. In this strategy, the target firm sells its most valuable assets, called as its crown jewel, to a friendly individual or company that is more favorable to the target. This friendly partner is referred to as white knight. Once the crown jewel is sold, the target becomes less appealing to the acquirer, who may then lose interest and withdraw its bid. The target company may even later repurchase its assets when the threat of acquisition gets neutralized. The white knight here is seen as a savior, as it prevents the hostile takeover and is more favorable to the target company's interest. The second strategy usually used is stock buyback. Under this strategy, the target company gives its shareholders an option that is very lucrative to buy back its shares at a premium price. If successful, the number of target company's shares available in the market to buy are reduced. Its stock price goes up and the acquisition becomes costlier for the acquirer, and it may again lose interest in the deal. So these are two common strategies usually used by the target companies to protect themselves against these acquisitions. Moving on to question number 8 now. What do you know about golden handshake? Now see, this is another important thing that you must know about. To make the acquisition process sail through smoothly, what the buyer does is, it provides the key executives of the target company significant severance package if they lose their job due to firing, restructuring, negligence or retirement after the acquisition. And all this is mentioned in their contract. The amount to be paid out is usually negotiated before the contract is signed. This payment can be made as cash or stock options or anything else that has been mutually agreed upon. This understanding and ultimately the clause in the contract is referred to as golden handshake. Moving on to question number 9 now. What do you know about merger arbitrage? Merger arbitrage is a strategy where the merger arbitrager simultaneously purchases and sells the stocks of two companies involved in a merger. This is done to earn a riskless profit from the price discrepancies. Now see, what typically happens in the discussion for such mergers is they start, but most of the times these deals either get delayed or never get closed. A merger arbitrager reviews this possibility and purchases the stocks before the acquisition to make the profits. You can see these type of investments are actually event driven to take the advantage of the inefficiencies of the market. Okay, now moving on to a question that actually tests a bit of your practical understanding. And the question is, why are mergers so common in technology and retail companies? Now, to answer this question, just think like this. In this age of technology, a lot of young people have innovative ideas and start their companies, but they lack the funds to grow and sustain. In such cases, the big companies usually acquire these smaller companies, helping them survive and scale up. The product is perfected and brought to a bigger market, making it a win-win situation for everybody. Now, if you look at the retail business, you would notice that it is a cash intensive business with a lot of cyclicity involved in it. A retail business may face challenges because of the cash crunch, stuck inventory, unpaid invoices, and other such things. Mergers and acquisitions provide these companies an opportunity to sustain and grow. This is the reason mergers and acquisitions are common in technology and retail companies. Okay, so let's move on to another question that tests your practical understanding. And the question is, why do acquiring companies' stock prices fall during an acquisition? Now see, the acquiring company usually pays a premium to the target company to close the deal. The money for this deal comes from its existing cash reserves, or it has to take a debt, which is viewed negatively by the market. So here are some basic reasons for the acquiring company's stocks to fall. The first one is financial load due to the payment they have made out. The second one is the mergers get delayed due to regulatory issues many a times. The third one is perceived overpayment. That is, the market and the investors may believe that the premium paid for the target company is too high. Then there could also be integration hiccups, because acquisition brings with itself a lot of unforeseen expenses. The work culture of the two companies may not integrate well and other such things. However, for the right type of deals, this initial fall is temporary. The stock prices rise again after some time as the acquisition process gets completed and the company stabilizes. So, you see how you have to think about these questions and how you have to actually put your thoughts into the words. But all of this comes with a lot of thought that you have given prior to the interview to these things. Moving on to question number 12 now. What is the effect of acquisition on the stock of the target company? Now see, the news of acquisition means that the acquiring company has seen some value in the target, and the acquisition is usually done at a premium, pushing the stock prices of the target company up. However, the opposite may also happen. That is, the shares of the target company may even fall on acquisition news. This would happen if the market perceives that the target company was facing some financial troubles, and that is why it was bought at a discounted price. Okay, now see, we have talked a lot about the mergers, but demergers also happen in the market. And your next question could be about that. And the question could be, what is a demerger? So, when a company splits off its divisions to operate independently or to be sold off, it is a demerger. The large companies usually do it to focus on their core operations. These smaller units, hence created, are spun off, sold, or liquidated. Sometimes even the government may intervene to break up a monopoly, which may lead to a demerger. The three most common types of demergers are: number one, spin-off. Here, the parent company receives an equity stake in the new company that is equal to the loss of their equity in the parent company. The second one is just split, similar to spin-off, but here multiple units are created from the parent company. And the third one is liquidation. Here, the assets are divided among the new companies, usually due to the conflicts between the management, board members, and shareholders. Now, a follow-up question to this could be, can these demergers add any value to the shareholders? And this may vary actually from case to case. The share value may fall in the short run after the demerger. But as the parent company and the new unit start doing better with more focused business, the share value may see an upturn, and this usually happens. In case the stock of the parent company falls, the performance of the newly formed unit can compensate for it. The conglomerates make thorough predictions and analysis before undertaking any such significant steps. So friends, this is all in my today's video, and I sincerely hope it was useful to you. If you have found today's video useful, do give it a thumbs up and share it with your friends also. For more such videos, subscribe to the channel now. I'll see you very soon with a new one. Till then, bye-bye and take care.